We're all subject to the behavioral biases when we're investing, but it's just easier to observe them in other people than in yourself.
The environment is changing, it's not stationary. The strategies are changing, they're not stationary. People are changing, they're not stationary, unfortunately.
There's a whole raft of behavioral challenges when it comes to selecting managers, and job security is a big driver of all of these biases. High volatility strategies can be very beneficial in impacting and managing the overall volatility of your portfolios.
You use the word robustness several times.
Yes.
The economy is so indebted, the governments are so indebted, the consumer is so indebted, it will bring along a revolution.
It's not very valuable being uncorrelated with equities in an equity bull market, but then being highly correlated with equities in an equity bear market.
Hello and welcome to Capital Horizons, the podcast where money meets politics. I am Igor Yelnik. This is Sir Michael Fallon. Our guest today is Dunne, founder of Alphidence Capital. Hello, Alan, and welcome to the show.
Good to see you. Thanks for having me on, Igor.
Alan, you spent your career investing in hedge funds, investing in macro hedge funds, in managed futures hedge funds, and now you are advising institutional investors and family offices on portfolio construction and investments, and in particular on investments in hedge funds. And the recent environment has been characterized with a lot of turbulence. We're having two major wars going on, one in Ukraine, another one in the Middle East. A lot of tensions between major powers, China increasing their military potential. Has it changed the investment landscape?
I think it has, yeah. I think we've seen a fundamental shift in the investment landscape in the last few years. We had a 4-decade trend of falling inflation and falling bond yields from around 1980 to 2020. And since then, we've had both changes from an economic perspective and a geopolitical perspective. And from an economic perspective, I think we've moved into a more of a supply-constrained world. So if you think about it, in the 80s and 90s, we had China coming into the world trading system, fall of the Berlin Wall. So it was a very positive supply shock, an outward shift in the aggregate supply curve, which was disinflationary. And that was a tailwind for financial markets because you had falling inflation and central banks could be very accommodative. And coupled with that, we had an era of, peace and prosperity and neoliberalism and free markets. And now we've moved into a new era where, arguably the end of the neoliberal era, moved towards more populist policies and, as you say, heightened geopolitical risk. And COVID highlighted the need for, certainty of supply chains over efficiency of supply chains. So we're seeing responses to that. So I think all of these are factors highlighting that we're into a more politically fraught and geopolitically fraught world. And obviously you mentioned Russia and Ukraine as well. The upshot of that, is higher defense spending. So putting all of those factors together, we're into a world where supply chains are less certain and we may see more periodic supply shocks. And I think that makes for a more volatile macro backdrop, which is arguably favorable for trading and hedge fund type strategies.
Yeah, it's interesting you mentioned that because some of the strategies in which you have historically invested are based on models. And when you build a model, and I can tell you this as a person who have built quite some models, yes. When you build models, inevitably you base your models on the past experience.
Yes.
And in mathematical terms, you are relying on stationarity in the underlying data. And what you have just explained so very well is that actually the world is not stationary. The world has been changing, and it might be changing even more significantly. And there have been shocks. So the distributions are very, very different from benign, like normal distributions, for example. So how do you think those model-based approaches are going to work in the foreseeable future?
Yeah, I think it's a good point, and I think you're right, because it would be very easy to construct strategies based on a particular market paradigm of, falling yields and quantitative easing and that type of scenario. And obviously we've moved away from that. So I think, as an allocator and thinking about asset allocation and strategy allocation, that has to be in the back of your mind when you're building up portfolios with clients. And, one of the things that we emphasize a lot is robustness. And I'm sure you think about that a lot yourself in terms of model construction, and the types of strategies that we like to put in front of clients and invest in are definitely robust strategies. So think of things like even simple strategies like trend following. It is a robust strategy for different environments because it's rules-based and it's adaptive, and it's not contingent on a certain set of macro conditions. It's obviously not the only strategy that can work in this type of environment, but it is interesting, if you go back to, say, maybe 2018, 2019, that period in the industry, there was a lot of interest in machine learning strategies, AI type strategies which had been conditioned on the environment we'd been in for a number of years. And then we went into 2020, 21, 22, and it was a period where we saw quite simple strategies, simple trend following strategies doing very well because they, got on board very significant trends such as rising yields, rising interest rates, the moves in equities over the period. So I think as an allocator, it's very important when you're, evaluating strategies, interviewing hedge fund managers to understand their process, understand how they think about robustness, and to ensure that you haven't selected strategies that are, developed with one regime in mind and are not adaptable to multiple regimes.
Perhaps I could just ask you here, Alan, how has that change affected your clients? What are you seeing on the investor side?
I think
in terms of appetite and maturity of these trends.
Yeah, I think what we're seeing is definitely the idea that we're into a different environment is resonating with investors. And, you could have made the case for this in 2020, 2019 bond yields were ultra low, US 10-year yields fell below 0.5%. And you could say, listen, there's obviously risks to bond markets here. And then as we moved into 2022, we saw the scenario play out that many people were warning about, that you can see concurrent declines in bond and equities, and the bond and equity correlation isn't always negative. So I think some people were probably, open to that suggestion ahead of the 2022, but then certainly after 2022, it's highlighted that is a clear risk. Now, interestingly, as we've got into 2023, we've had higher bond yields and bond markets were again interesting for investors to invest in. So, and as soon as you get a wobble in performance in diversifying strategies and hedge fund strategies, people immediately start to question, are they still worthwhile? Or, do I have enough diversification with my bonds? So I think, the case is not always one, you always have to kind of point to the evidence, make the case. But I would certainly say there's a tailwind of interest in, what you might call liquid alternatives or hedge funds or diversifying strategies. And I think that 2022 experience is still reasonably fresh in people's minds. Notwithstanding, people can make the case, bond yields were very low then, so you mightn't see such an exaggerated sell-off again. But certainly, I think people understand the general point that bond equity correlation can be positive, and that can be quite problematic to portfolios if you don't have true diversifying strategies.
Well, with regards to stock-bond correlation, we saw positive stock-bond correlations before, right?
Absolutely.
It was the case in the 90s, yeah. And so this shouldn't have come as a surprise. But maybe one of the problems is that the investment industry is a very young industry, and nobody, or almost nobody working in the market today doesn't remember, let's say, the Black Monday in 1987 and wasn't even around even in the 90s, certainly not in the market in the 90s. They don't have this first-hand experience.
Yeah, no, for sure. Yeah, no, I mean, you're right. I mean, a lot of people, a lot of portfolio managers have come into the market since the financial crisis, so some haven't even experienced that. But even if you've been in the markets 30 years, or as long as you or I, we've always been conditioned on falling yields. But I mean, it doesn't take much to look back at the history books, and we saw the experience of the 1960s. And particularly the 1970s of inflation taking hold and how difficult that was for financial assets, negative real returns for bonds, and very little in terms of real returns for equities over a prolonged period. From 1966 to 1982, equities did very little in real terms. That's a long time. That's nearly half a career for some people. But and that's totally different to the environment we've lived in for the last number of decades. So I think you have to be conscious of the fact that the conditions that we've had in the last number of years and even a couple of decades have been very unusual. And, that point about the shift in the interest rate environment, think about the number of strategies that did well in the 2010s or the 2000s, conditioned on low rates and ample availability of credit, so private equity, all of these types of strategies. So I think it is a reasonable question to ask, will the environment be as favorable going forward? And equally, some of the strategies which struggled, things like commodities and trading strategies, you can make a much stronger case looking ahead for those types of strategies in portfolios.
Yeah. So you mentioned private credit and private equity. I think this is quite an interesting topic because these strategies have been super popular recently, and I don't think the popularity is falling right now. And people who are involved in these strategies can make a very strong case for why such strategies should perform in the future. What you pay for it as an investor is you lose liquidity. You are losing access to your own money, and supposedly you are gaining some illiquidity premium for it. The jury is still out about whether you actually get this illiquidity premium when you invest in private equity. What do you think about it?
Yeah, I think it's a good question, and I mean, people talk about private equity as one asset class, and obviously people have much differing experiences depending on who they're invested with, and there's been lots of studies done on this, some questioning the returns. Are they really as strong as is suggested, or is it just the leverage that accounts for most of the higher returns? Private equity managers point to the operational alpha that they will deliver, but is that it's hard to know, and equally how the performance numbers are presented in terms of IRR ratios. Is very different to the environment we come in, which are kind of fully funded investments. So I think it's hard to speak in general terms. I'm sure there are good opportunities in private equity. I would just make the point that maybe the macro environment isn't as favorable when you go from an environment of zero interest rates to 5% rates or 4% rates or whatever it is. Logic would dictate that the asset values are. You're not going to see that level of appreciation in asset value. So the opportunities would be, at least at the margin, less attractive. But, I think, as you say, there's been a wall of money into the space. I don't think that's going to change. But I think investors have a lot of exposure. Institutional investors have a lot of exposure to private markets now. And, speaking to some of allocators that I know in the institutional space, there's a suggestion that, the growth of assets that we've seen in multistrats, the pod, that they were the initial beneficiaries as a lot of large institutions started to rebalance away from private market exposures to get some public market hedge fund exposure. So I think there is that rebalancing underway. Not to say that private markets are not going to be a big feature of the landscape going forward. I think they will be, but I think we're into a changed macro environment.
Okay, you mentioned multistrats, and this is a big topic. This has been an ever-growing topic for the last, 10, 15 years probably. Although the concept is much older, of course. We have those massive behemoths with a lot of what they call pods, i.e. trading teams, which are allocated a certain risk budget, and very tight risk management rules, and very good risk management on top. And the amount of money invested in those large multi-strategy funds is enormous. There is a war for qualified portfolio managers, war for talent, as they call it. What do you think about the growth of multi-strategy funds as an alternative to what used to be very popular before, i.e. traditional funds of hedge funds?
Yeah, I think I think as you say, the concept isn't new, but what they've taken is an existing concept and really enhanced it and exploited it to its fullest, in the sense that, you know, traditional fund of funds combine different strategies to get a more consistent return profile. But what you got with more traditional fund of hedge funds was an overall portfolio that looked very low volatility because there wasn't any leverage in the portfolio. So it was low vol and low returns, and you still had, you know, 2 layers of fees. So overall, fairly uninteresting for investors over time, unless you were able to lever up, you know, using managed accounts. So I think that's why the fund of hedge funds, traditional fund of hedge funds, struggled, particularly as we went into the 2010s and you didn't have the additional support from the interest rate side. What the multistrats have done well is obviously taking that idea of finding uncorrelated strategies and lever that up to a much greater extent. So the model is so contingent on finding numerous strategies that are uncorrelated with each other and then leveraging that up. And then it's also contingent on having good risk management, as you mentioned. So that the problem with multistrats and with a lot of quant strategies is if everybody has the same position on at one time and you get a shock or a pickup in volatility and you get what's called a deleveraging or a degrossing effect and everybody is rushing for the exits to get out, then you can have a very sharp drawdown in performance. So what the multistrats are good at is looking at across all of the risks that they have in their portfolios and taking active trades to balance those risks and to generate more consistent return profile. So, I mean, to date, you know, for the very best managers, the likes of Millennium, I mean, you can't argue with performance. It does seem to be very solid. Now, you know, are they still a competitor to hedge funds now, given that their liquidity profile is now changing? You know, they're arguably more of a competitor to the private markets because you have to lock up your capital in some instances. So I think, you know, I think for some investors, they're viewed as a one-stop shop, get some trading exposure, multi-strat, all into one allocation. So that's fair enough. I think for other investors who want to build a more particular type of return profile in their portfolios, maybe they're less of interest. You know, if you have a lot of beta in your portfolio already and you want convexity and strategies that will do very well in times of stress, you know, it remains to be seen if these strategies will always do well in those types of periods. So that's why I think other strategies can do better in that type of environment. And I think there is a question as to, is there some risk there? You know, we had COVID and March 2020. There was significant strains in the US Treasury market. With obviously this basis trade where the multistrats have been heavily involved in trading cash bonds versus futures on a leveraged basis. That temporarily came unstuck, and obviously the Fed had to intervene aggressively. So, you know, you say they've been around 10 to 15 years, and they have, but I would say it's really in the last 5 years that the assets have really grown significantly. So I think there is a tail risk there, and that we don't know what types of shocks we will have going forward and how they'll navigate those shocks. You know, with that March 2020 being one example.
Sorry, Alan. Did I hear you correctly that practically you suggested that there is a possibility of systemic risk events coming out of multi-strategy funds?
I think there is, and I think that we saw that in March 2020. I mean, you could take the other side of that and say their trading is so large that the central banks would always have to bail out you know, these trades in those types of scenarios, and that's effectively what we saw in COVID. But I suppose my point is we don't know, because the landscape in terms of their assets has shifted so quickly that it would be in the back of my mind as a possible risk.
If we look at it from the investor's perspective, and most investors have some equity risk on their books, and it may be as high as 60-70%. Sometimes it's lower in some jurisdictions, but let's say if we think about the US, it will be somewhere around 60% at least. When you add a multi-strategy fund, which is likely to increase implicitly your equity exposure, that's not a problem because you are having this equity exposure anyway, and you are adding some returns on top of that. So it's fine. And you are locking your money for a long time, but you are a long-term investor. You are a pension fund. You don't need your money tomorrow. If you can get your return for a let's say, for a considerable long period of time, is great. Now, it does save you the trouble of investing into individual hedge funds. You don't need to run this selection team. You don't need to have all those endless committees thinking about where to invest, where to redeem. So problem solved, right?
Yeah, I mean, I can see the attraction from that perspective. As I say, I think, they do manage their risk to be factor neutral. So that would include the equity beta. But they're not particularly designing the strategy for strong performance in times of stress or for convexity or for those types of environments. So if you look at typical institutional portfolios, very often you have public equities, private equities, you might have multistrats, you might have real estate, VC, credit. It may look diversified at a high level, but ultimately all of the strategies are strategies that are contingent on solid economic growth and or flat to falling inflation and interest rates. So as soon as you go into an environment that is different from that, you get challenges in your portfolio, as we saw, as I said, in 2022. So that's why I think increasingly investors need to think about the fact that from a macro perspective, we may be going into a more volatile macro environment. And what I mean by macro is, okay, maybe not the 1970s in terms of a trend higher in inflation, but certainly more volatile inflation, and then more periodic shocks and periodic episodes where traditional assets and assets linked to the economic cycle are more challenged. So yeah, I think multistrats, fine in terms of capturing uncorrelated returns, but maybe not the best strategy and solution in terms of finding convexity and diversification, particularly if you're trying to, think about having some strategies in your portfolios that can do well when equities become much more challenged.
Coming back to the new era that you've been sketching out for us, and the investor appetite, how is that affecting differently family offices vis-a-vis high net worth and institutions?
Yeah, it's a good question. And I think what you find is a spectrum of knowledge and sophistication around alternatives and trading strategies. I mean, you speak to some people and they're saying, we're thinking of investing in alternatives, more or less for the first time, and they don't have that experience. And, you come across a lot of people in the multi-asset, in the traditional space. They come from an investing background, a traditional bond or equity environment background. So trading strategies are quite different, and particularly quant trading strategies can be quite foreign to people. So I think there is a lot of learning there. Equally, you have much higher levels of sophistication. If you look at, say, public pension funds in the US, they already have categories such as risk mitigation strategies, prices risk offset strategies, systematic convexity. So portfolios and investors who are very much attuned to the risk that you can have periodic, drawdowns in equities, and actively assessing the strategies for inclusion in those particular buckets. So I think there is a large variance in terms of the investor knowledge and experience and expertise around this. I would say certainly a trend increase of interest in, as I call it, liquid alternatives or hedge funds. I mean, certainly hedge funds have had their ups and downs, but I would sense that in the last few years, we've seen a certainly stronger interest, and on, it was quad macro going back a few years. Certainly discretionary macro has seen much stronger performance in the last number of years. Some of the largest discretionary managers, discretionary macro, were effectively closed for a few years, just managing their own family, managing like a family office. Now they're back out raising capital again. And, an environment of more inflation volatility means more interest rate volatility, means more currency volatility. And we've seen that. We've seen carry trades and unwinds of carry trades. So you'd certainly say that we're seeing much more of a macro-driven world and much more of a more volatile environment for trading strategies in the last, I would say since 2019 or so. So I think that hasn't gone unnoticed from investors, but I would say definitely it's been picked up at differing paces.
And is it too early to start looking at some of the mistakes that have been made in the new environment?
Well, I think there's always challenges, for investors constructing hedge fund portfolios and allocating. And, it's really interesting from my experience, having been part of a fund of hedge funds and now working with clients on an advisory basis, you kind of get to observe the decision-making process. And, we're all subject to the behavioral biases when we're investing, but it's just easier to observe them in other people than in yourself, which, it's the curious thing. So I think that there's still work to be done. One of the classic things is people evaluating strategies on a single line item basis, so on an individual basis, rather than thinking about what's the impact on the overall portfolio. So much of the marketing of strategies is conditioned on, this is a high sharp strategy, it's a low vol strategy. But actually, from a portfolio construction perspective, high volatility strategies can be very beneficial in impacting and managing the overall volatility of your portfolio. So there's that distinction between how you appraise an individual allocation versus how you appraise the overall portfolio. And that can be a difficult message to get across to people because, as I say, because there's a natural bias for this looks like a great sharp strategy, but if it's a one sharp on 5% volatility, it's not going to meaningfully move the needle in the overall portfolio. So I think that's one thing that's certainly a challenge. Another thing is, particularly once you get into the hedge fund world and the quant world, it's very hard for investors often to adopt a statistical mindset. I find, people always look at track records and, extrapolate them forwards. Very rare for people to say, well, let's test the null hypothesis that this manager has no skill and try and reject that. I mean, which would be the kind of proper statistical approach to take. Instead, if you see, 10% annualized returns over the last 5 years, it's kind of extrapolated as, this is a 10% return type strategy. Obviously in the background, people know that it could have been an element of luck, but I still think there's a natural bias to say, well, there's a good story around why this manager is delivering returns and the power of the narrative.
Particularly if there's a name attached to it.
Absolutely, yeah. And I mean, that's another narrative, particularly if you're a new manager coming out of an established house, there's that natural bias in favor of those types of managers. So there's a whole raft of behavioral challenges when it comes to selecting managers. And, I think, I do a podcast speaking to allocators, and, I think people would agree that the skill of selecting managers is quite a different skill from security selection and portfolio construction from that perspective. So it is quite interesting.
Do you mean selection of securities or your personal job security?
Well, that's important too. I mean, job security is a big driver of all of these biases because, career risk is huge. And if you think about it, everybody either has a client to report to or an investment committee or a board. You might logically think institutions would be more sophisticated, but very often it's the institutions that have governance structures that involve non-investment personnel. So there's a reluctance to get into things that are maybe more complex and strategies that might have longer drawdowns, because from the career risk associated with it. So I think, but my point was more around it, that there is a very large qualitative element in selecting managers and building hedge fund portfolios, where obviously, equity market portfolio construction is purely quantitative for them. obviously there's a qualitative element in kind of forecasting returns, but it's a different skill set, and I think that's where you get the challenges and the mistakes.
Yeah, it's interesting that you are speaking about quantitative analysis of investments into hedge funds. Don't you find that there is a little problem associated with that? First of all, you have very short time series, very short track records. Even 5 years of data, of monthly data, is still not enough for you to draw any significant conclusions. And also, as we have already discussed, the environment is changing. It's not stationary. The strategies are changing. They're not stationary. People are changing. They're not stationary, unfortunately. How can you run a statistical analysis when you have every part moving?
That's a good question. And I think you can't ignore the data, but you've got to be skeptical of putting too much weight on it. As you say, I mean, to statistically infer skill, I mean, certainly you'd be better able to tell me what's the exact number of years or months, but it's 3 years, 5 years, maybe more, to be able to, categorically say that a manager has alpha. What would you say?
Yeah, well, if you have, let's say, 0.5 sharp strategy, then you will need 16 years of data to be statistically significant on the 95% level.
Yeah, there you go.
Yeah, and 0.5 is your typical managed futures sharp ratio, right?
So that's why, as I say, I mean, I think the data is relevant, but the qualitative element is very important too. And then it's a matter of ultimately it's a matter of forming an appraisal of the portfolio manager, even for quantitative strategies, because obviously hedge fund managers will make changes to the portfolio. They'll have to decide whether to add new strategies, remove strategies. They're all discretionary decisions. Okay, you might have quantitative rules around that in terms of drawdown for individual strategies and rules around removing, but still, the manager then has the question of, okay, if the environment changes, am I maintaining my current system, or am I tweaking it, or am I adding new systems? And obviously, you don't want a hedge fund manager who's overly reactive to what's just happened, that they need to take a more of a pragmatic, longer-term mindset. So I think it is, at the same time, you talk about the 0.5 sharp, if you have a 0 sharp, it's hard to make the case for that, because people will, even though it's statistically doesn't mean no skill, but it's a tougher one to put in front of investors or to allocate to. But you're right. I mean, that's my point. That it is hard to bring that statistical mindset to the allocation process, and very often we just look at the returns and immediately infer skill when randomness is a huge driver.
Another argument which I always hear, or maybe not always, but quite often, is the following. Why go through all this trouble of investing in those obscure hedge fund strategies when I can invest in S&P 500, and typically people show the chart of S&P 500 over the last 100 or 150 years, and they tell you, what else do you need?
Yeah. No, it's a fair. I mean, it's a fair point if it's a multi-generational portfolio, and you've got an ultra long-term time horizon. I think for most investors, it's fine to say that, but when you are in the midst of a 30% drawdown, or even we've had 50% drawdowns in the S&P 500 since 2000. Now, 50% is pretty bad. It's a big, and bear in mind when you're down 50%, your portfolio has to be up 100% to get back to flat. So that's the kind of the volatility drag. But also keep in mind when you're down 50, there will be commentators telling you that things can get worse and that we're going to go into a depression. And then the most recent example was COVID, which was, I can't remember, more like a 25-30% drawdown. But certainly at the depths, people were saying this is going to be as bad as the Great Depression. It obviously ended up being a V-shaped recovery, but we weren't to know at the time. And we've had 50% drawdowns. That's not to say that we can't have bigger than that, or in real terms, as I mentioned, if you have higher inflation and a drawdown in equities, you could have bigger drawdowns in real terms. So yes, if you have the staying power, you can sit through all of that. That's fine. But, it increases the likelihood of making an error at some point that, when the market's down 40, 50% and people are saying things can get worse, that you sell something or make a change. And also it ignores the fact that you can, allocate the strategies that could make gains when equities are down 30, 40, 50%. And then you can crystallize gains on those strategies and reallocate and take advantage of the lower valuations in equity. So that rebalancing effect helps you compound at a higher rate. So for all of those reasons, there has been plenty written about this, that even though equities have delivered the highest returns over the long term, a pure equity portfolio isn't necessarily the right answer from a robustness perspective. And we don't know. I mean, obviously the last, even if you take, there's a debate around, Jeremy Siegel's data is the classic data around this, returns of about 6.6% real, 10% nominal. But that's going back to 1900. There was another academic studied the 1800s and said, well, actually it didn't look as good back in the 1800s. Now you might say, well, what's the relevance of the 1800s we're in 2024, But the point is that the economy goes through shifts. We don't know what's coming ahead. It's feasible that we're into a more difficult environment. So, I think it's important to build portfolios from a robustness perspective.
Alan, I agree with you. But the markets are eventually pretty sure that the Fed is going to save them.
Hey.
This was not the case 200 years ago, but it's going to be the case now because the economy is so indebted, the governments are so indebted, the consumer is so indebted that it will bring along a revolution.
Yeah.
If the markets go down 80% because people will start losing their houses, and these are exactly the same people who vote.
No, it's a fair point, and I think the Fed put is real. I mean, the one thing I would say is the central banks haven't really been tested on this in the sense of COVID, obviously, initially was a deflationary shock, so it made sense to add a lot of liquidity. Now, as we got into 2022, you might say, okay, they face something of a policy dilemma in the sense of having to raise rates in the face of weakening economic prospects. And they said, okay, we'll do what it takes to bring inflation down. But at the same time, unemployment was, 4%, less than 4% through that whole period. So they never really had that dilemma of having to raise rates in the face of inflation at a time of weak economic growth or a capital market shock. So the problem is, if you get one of these equity market downturns and significant shocks, when inflation is embedded in the system, will the Fed put be there as quickly? Maybe it will. Yeah, maybe you're right. And I think there are arguments to say, given the financialization of the system now, that the Fed put will maybe always be there. The question is where at what level? Is it 10% down, 20%, 30%? I think one of the upshots of all of the debt is the need for more liquidity provision over time. But that in itself also creates opportunities. In obviously what we're seeing in gold at the moment probably reflects that. But it probably also means more volatility, which is also favorable for trading strategies. So I hear you. I mean, there is a compelling argument to be made that we'll never see a 70-90% decline in equities like we saw in the Depression. Equally, I would say never in the financial markets, and policymakers make mistakes, and you don't know what set of circumstances could arise whereby, in the midst of a downturn, a policy error is made. Even look at the global financial crisis. The market was down, and then it accentuated when the House rejected the policy package initially. So policymakers can make errors until it gets too bad, and then they tend to be propelled into action. But so I agree, but I would say, yeah, you can't assume anything in the financial markets, and you do have to plan for all eventualities.
You have been investing for all your professional life. You have spoken to so many hedge fund managers. You have spoken to so many asset owners, investors.
Really?
If you were to give an advice to those investors, give me 3 bullet points.
To the investors, yeah.
Yes.
I think the first thing would be think about constructing the overall portfolio and don't overly focus on the line item. So we've talked about that. And the second thing, certainly be cautious about the allure of the narrative and try and think with a statistical mindset when assessing hedge funds. It's easy to be drawn in by the narrative, but the randomness is a big feature. So don't be fooled by randomness is I suppose the second thing. And I think the third thing is try and construct portfolios to be robust and diversified, which means you can't just pick a load of high sharp strategies. You have to think about scenario analysis, stress testing. Do you have strategies in your portfolio for different types of scenarios, even if they may not do that well in your base case? So try and think from that kind of robustness perspective when constructing portfolios.
You've used the word robustness several times.
Again, yes.
And I'm interested in this. I mean, are there types of stress that concern you as a threat very recently or ahead of us that we haven't seen before?
Well, obviously, anything that's short volatility is the opposite of robust. If you get and we've seen this in July, August this year. We've had the unwind of the carry trade and a spike in volatility, and that was problematic for some short vol strategy. So short vol is the classic, not robust strategy or fragile strategy, I guess.
But we had seen that before.
We have seen it before,
in previous decades.
Yeah, but equally, going back to COVID, what we saw, we did see strings in the credit markets, and again, the central banks had to bail us out. So I think things like credit is an interesting one, because often what you see with some strategies is they might be, maybe 0.3, 0.4 correlated to equities overall, but that's masking is, they'll tend to become much more positively correlated with equities in an economic downturn, and their volatility picks up in a downturn. So actually, looking at the average correlation over time isn't that informative. You have to delve in and think about, what's the strategy going to do if we really get a negative tail event from an economic perspective or from a capital markets perspective. So I think that's where the thought process around robustness is really important. That is, you can't just look at the performance, throw it into an optimizer. It says, it's uncorrelated. But it's not very valuable being uncorrelated with equities in an equity bull market, but then being highly correlated with equities in an equity bear market. So that's where understanding the inherent risks in the strategy, is the strategy reliant on the provision of liquidity in some way? We saw that with levered property transactions during the global financial crisis. They wouldn't have been necessarily very positively correlated with equities, but then you couldn't refinance these transactions. So that's the kind of thought process I think about scenario analysis and stress testing and thinking about, what are the scenarios where it won't work.
Okay, and you have given brilliant advice to investors. Would you now give 3 bullet points of advice to investment managers?
I think for the investment managers, I think it is what you find with the investment managers in the hedge fund space is all of the people who run hedge funds and have managed to launch a hedge fund, the vast majority of them are very capable, exceptional people. They come with excellent academic credentials, have often been very successful in other areas, and then they come into the hedge fund space. And it's so competitive that you're then just average within the whole hedge fund world, that you don't necessarily have the biggest or the best hedge fund. So it can be quite a challenge for these people who Twitter lives have always had, success and etc. I think that, the thing I would emphasize is, one, doing the basics right is an important one. Very often you'll meet a hedge fund manager and, the strategy is somewhat interesting, but you're not going to allocate tomorrow. But that doesn't mean that you won't at some point. So it is important to follow up, keep in touch, send a monthly report. And it's amazing how many managers don't do that. So you meet them and then you don't hear from them again. So I think that's the first thing is do the basics, send out your reports, follow up. The second thing is have realistic expectations from the allocators. Very often, having come from the fund of hedge fund side, if the allocator runs a portfolio with very little turnover and there's 100 CTAs that they could allocate to, be realistic. The chances of an allocation are low, but it's not zero. But think about it from the perspective of the allocator. Yes, you might have good performance, but there's lots of managers with good performance. So be realistic in terms of what to expect from the allocator. And I think also be realistic in terms of the guidance. We talked about the statistics and what you can expect. If you're an investor presenting, a back test that looks fantastic with no drawdowns, allocators will know that this is not going to be what reality will look like going forward. So understand that. So be realistic in terms of what a strategy can deliver, when it'll deliver, when it won't. And it's okay to say it won't deliver in certain environments. Allocators understand that. So I think it's more irritating to allocators if somebody says, this is going to be a 15 vol strategy and the worst drawdown is going to be 5%. You're saying, well, I doubt it, So it's kind of an immediate negative mark for a manager coming in who doesn't present themselves as being pragmatic and realistic. So they would be I think that's 3 points.
Okay, and my final question to you. You mentioned that hedge fund managers are like smart people who have excelled in other areas, for example, in research, in science, and in computer science. Yep. And nevertheless, somehow they all flock to this highly competitive area where it's very difficult to make a difference, where all the chances are stacked against you. So why, instead of doing some simple business, opening, car washes, all these super smart people go and do the most difficult thing?
Well, I think, there's one, obviously it's financially lucrative, so it's, that's an obvious one. But I think it is so interesting. From my seat, I've been in the industry, nearly 3 decades. It never gets boring. It doesn't grow old. There's, even for hedge funds who are successful, the battle is never won. Things can unravel very quickly. We've seen hedge funds, multi-billion dollars go to zero very quickly. If they take a misstep. So it's a very challenging environment to try and be successful in. But for people on the macro side, it's inherently fascinating. People on the quant side, there's the ongoing challenge of trying to build the perfect model and the perfect portfolio. So it's endlessly, intellectually challenging and interesting. And then obviously it's not just intellectually. There's the business challenge of trying to start and grow a business in this space, which is a different set of skills as well. So I think it presents such interesting and unique challenges, and obviously the rewards are there as well, which is obvious to say.
Yeah. So you're saying that we love the game.
Exactly. Yes, that's it. Exactly.
All right. Thank you very much, Alan. This has been very interesting. Thank you very much for joining us.
Not at all. No, I enjoyed it. Thank you.
Thanks for listening. This has been Capital Horizons.
So if you would like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I, see you next time.